Welcome back to the CPA Revolution. I'm Charina Padilla here with our tax strategy expert and co host, certified tax coach and CPA, Jose Ortiz. If you are tired of traditional reactive CPA advice and want to turn taxes into a wealth building tool, you are in the right place. All right, welcome everyone to another session of the CPA Revolution. Now that 10:15 is over, we want to make sure that we are being proactive and bringing the information that you will need to end the year successfully, right? And
Right.
every high earner knows that one feeling, that one pit in your stomach when you see how much your hard work will end up with
Yeah.
the IRS. So today we're going to share how you could legally turn $100,000 in investments into nearly $1 million in deductions without buying another building or taking on risky tax shelters. So here today with Jose, we have Michael Sims. I'll pass it on to you guys.
Yeah, so thanks, Serena, and happy Monday to you, by the way. So yes, October 15th deadline has come and gone. Now we have everybody turning their attention to 2025, right? And we have some people who are kind of like starting to sweat it out, right? Maybe, all the things that we've talked about in the last few episodes, Section 1202, right? Maybe they're a business owner, but maybe they're not a specialized service trader business, so they can't qualify that kind of stuff. So the 1202 won't work if they sell their business. As far as offsetting capital gains, maybe QOZ is not their kind of thing, a qualified opportunity zone. Maybe they just want to get out of real estate, period, right? And keep those capital gains from being taxed as much as possible. And, they don't want to do a Section 1031. So when I have that kind of client, or maybe, a latecomer, it's never too late. Well, I don't want to say never, right, Mike? 1231 is probably too late. However, when I have those latecomers,
January 1st is too late.
Yeah. So when I get these kind of latecomers, basically the first guy I call, if there's nothing else that we can do, is Mr. Michael Sims. Mike is from Veracity Advisors. Mike, tell us a little bit about your firm.
Yeah, Jose and Charina, good morning, good Monday morning, and it's a real pleasure to be here with you guys. I always like to feel like I'm the dumbest guy in the room, and I certainly have that sense right now, so thank you. Veracity Advisors, we're what's called a fractional family office service provider that delivers in a virtual capacity, right? So we work with CPAs and advisory teams for their best clients. We can work individually with clients, but really where we shine the best is when we're collaborating with your CPA, and we happily work in the sandbox with all of them, ideally to achieve the best result for a client. If they're an entrepreneur, we touch everything from risk management programs, business advisory and coaching programs. But this time of year, Jose, since this rolls around, we start talking tax strategies because we do a lot and have access to a lot of advanced tax planning strategies for clients on a one-off basis, but also on multi-year planning bases. So it's important, that your professional CPA or tax advisor, tax team reach out, because oftentimes they live in the world of compliance. Our job is to bring proactivity to them for their best clients.
Exactly. And that was actually going to be my next question to you, Mike, because it's so important to work. And, we keep kind of beating that drum on this show. It's so important for you to work with a strategic and proactive CPA if you're a high earner. I mean, you're getting nailed if you're not, right? And if you don't have the kind of sight that a strategic CPA can give you, you're really at a disadvantage. Am I wrong?
Well, I always love to remind even CPAs there's got to be near 78,000 pages in the tax code these days. And if you printed it on double-sided paper, and that's over 12 feet tall. And so, I always like to ask CPAs, how many pages are you expert at? 500, 1,000. Think about the amount of information that's in there. And really what we've come to learn in our dealings, because we deal with family offices, we go to investment conferences. My partner just came back from an alternative capital conference out in Dallas, Texas. And here he is in the room with all these family offices that people are paying $10, $20 million a year to employ. And we're doing the very same programs and even more than they're providing for their clients. So these are strategies that are ultimately used at a superior, ultra high wealth level,
Yeah.
but they're accessible to everybody, and everybody should have the right to use them. Our biggest battle, and Jose, I think you've seen this as well, is sometimes if it's too easy, clients get scared because they're
Yeah.
so used to their tax preparer staying within very narrow boundaries.
Yeah.
And these are programs that, the ultra high income earners and high wealth families use on an ongoing basis. We're just making them accessible for high net worth earners and people who are developing their own success.
I
Right.
love that. And
Yeah.
that's obviously where LEOS come in. It's a strategy, not a loophole, and it stands for the leverage entity ownership. So it's just leverage done right.
What's funny is variations of this program are used in hedge funds, private equity funds to mitigate and offset taxes. Business owners use components of this strategy. I always remember that for a while there, you would see all these videos of people saying, let me show you how to, buy an airplane and get the tax. Yeah, you set up an LLC, fund it with some money, take out a huge loan for an airplane and take the depreciation of the airplane as the write-off, and that impacts your taxes. Great. But now you got an airplane and you have to use it for business purposes. How do you maintain? You had a residual cost and impact of that structure. And I don't think that was always taken into it. And what this program does, and our service provider that we work with has been doing this for almost 14 years, but it's the creation of an LLC, a trading partnership that the client's involved in. And what's key at the onset is it's a series LLC. There's only 11 states in the union that allow for the formation of series LLCs. And we could probably spend an hour discussing series LLCs because of their flexibility and their ability to share assets and liabilities and profits and losses and how you could use it in real estate. But in our situations, we're all residents of Florida. Florida does not allow for the creation of series LLCs,
Right.
but Delaware does. And so
Right.
who we work with creates a series LLC out of Delaware, and they're essentially the master. I always think of it in my head like, Independence Day, where you have the mothership come down and you have all these separate cells. That's how it's set up. You create a cell of this master with the master, and you're protected legally and financially from all the other cells, right? So it is an independent entity. It's just connected through the master. The really interesting thing is you as the client are 99.9% owner, right? So the master is only 1/10 of 1% owner, but that's all they need to create the entity as a multi-member LLC, and for the tax treatment to be dealt with accordingly. So you have a multi-member LLC, and the beauty of the structure is that the client would make a capital contribution. While we're talking long-term capital gain issues, this also works with ordinary income, a 1099 income, but the client would make a capital contribution, and to match the capital contribution, the master series partner arranges through a third party a deficit restoration obligation, a DRO, which is a form of debt to the structure. And the interesting thing, Section 704 of the IRS code allows business owners to use debt when calculating the basis of the entity, not necessarily the real value, but the basis of the entity. So, Jose, if you were offsetting long-term capital gains and you contributed $100,000 into the entity, our partner would arrange for a DRO of $900,000. So now 100 plus 900 equals $1 million of basis.
Sorry, Mike, that's a really important concept right here, because what does the DRO allow? Is it kind of like the trigger to say, hey, you're taking on some kind of debt obligation, so now they're skin in the game, and that's how the IRS sees it, right?
Right. They created debt, and it's contained to that cell series. It doesn't show up on anyone's balance sheet, right? It's contained specifically to that cell series, and it's an obligation to pay a debt to the cell series. It's offered in the form of a line of credit. It's an advance on losses, and there's got to be a tie-in. It's validated as a debt to the structure, and there is an ongoing ongoing internal obligation to pay interest on it. But what it does is it establishes that basis now at $1 million level. And we know, and most people, I don't know if they realize, clients don't realize, you can take up to the full amount of the basis as a deduction for losses. You can't, have your contribution be 100,000, no debt. Now your basis is 100,000. You can't take more than 100,000 in losses. So this creates an enhanced basis, and then the master shares, right? Because the master can share assets and liabilities, profits and losses. The master series can then share losses down to the cell entity to fulfill the losses that are going to be written off on the K1. Right. So it sounds really, really complicated. In essence, how we operate it with clients is very, very easy. We educate the clients when they're comfortable with it. They sign some DocuSigns for the operating agreement. They wire their contributions. They get a K1. We manage with our partner the functions and format of how the entities are structured, how the debt gets shared. It's very minimal impact on the clients, but we do take them through a thorough process of understanding how the debt increases the basis, how the losses are shared, how they get a legitimate K1, and how it's offset by what the partner reports, right? So the first trigger that was if you have this EIN number for a new entity, and all of a sudden someone's showing $1 million of losses and it's not offset with any gains, the IRS is immediately going to identify that as trigger. The kind of the curious and valuable element of this is that our partner has been headquartered in Puerto Rico for about the last 5 years, right? So when they're reporting gains, they're subject only to the Puerto Rican tax laws, which is paying 4%. So we're really transferring a lot of the tax load into that structure.
I love that.
Yeah,
I would say, like, if you ever wondered how the top 1% seems to stay a step ahead on taxes, this is one of the plays they're running with. So I love, you only get this information here at the CPA Revolution.
Yeah, and it's the beauty of it is that DRO, I would say the DRO is a 15-year obligation. The structure of the program is a 15-year deferral. And however, we do offer clients the opportunity late in the structure, do they want to refinance? And at really no additional cost, they can refinance that DRO to an obligation much further out. Ideally, the optimal outcome, maybe not for the individual. Unfortunately, we had a client, 3.5 years, he's done it for 3 years, every year for his earnings. 35-year-old passed away earlier this year. Now, what happens when he passes away is that his heirs inherit and receive his ownership in the series LLC, and it receives a step up in basis under the current tax laws. So that tax that it's been deferred, right, now is absolved because the basis is increased. And when reporting the earnings with the basis increase, there's no residual income tax to his heirs. And there's a cash component. There's an element of the assets have to stay in a capital fund that can then, however much it's grown, that gets distributed out to the heirs with a step up in basis as well. So the kind of the beauty of this is, I like to say, Jose, we talk oftentimes, when we analyze strategies for clients, we want to understand from the client how much ownership they want to have in the asset after the transaction, how much liquidity they want from the assets, how much control do they want of the assets, and ultimately, how much income, or how do they want to create income with the assets. There are several strategies you can do where you can run around and tell your friends you paid no tax, that have no expense, but at the end of the day, you don't own the assets anymore. You've transferred them into a trust, and a foreign trustee is managing the assets. Those 4 elements, ownership, control, liquidity, and income, are really the key indicators to analyze any strategy's outcome for a client. You mentioned qualified opportunity zones. We love those. Those are great strategies for deferring, but you're locking the money away for 10 years into that structure. So it's really having to analyze for yourself as a client, what do I want from the assets? If the objective is, Charina, we talked about this, if the objective is to pay no taxes, write a check to a charity,
Mhm.
but then you don't have the ownership control it, right? So it's really for the client to understand how much of the assets do they want liquid, do they want to do with, if they want to get out of real estate, or they're having a liquidity event of a business or stocks or anything like that, what do they really want from it? Because when they understand that, that's where we can all collaborate together and learn what are the best strategies. LEOS is a phenomenal strategy for someone who wants maximum liquidity, maximum control, and maximum ownership of the assets. Ultimately, their unrecovered cost from the program is 10%.
Right. If I remember correctly, there's an income element there.
Well, it could be. I mean, they're going to contribute money into the structure, and 50 to 60%, depending upon what we're offsetting, is going to go into a capital account. The capital account needs to remain positive to validate the DRO, and that can be set up to produce strictly income. The minimum amount of income it's got to produce is 4%. That's got to pay the internal fee, right? That's not
Right.
external. It's not there are no annual fees or requirements on clients. It should be taken care of internally. If we put them in an alternative income fund that gets them 14%, right after they service the internal fees, they can produce 10% income. Or if their vision is, the step up in basis, then they can put it into crypto or real estate. They could put the remainder of that amount into capital appreciation assets that are not driving any sort of income. That's, every client's different. That's where we need to work with them and figure out. We will work with their asset management teams. If they want their asset management team to run it, we have resources where we can run it ourselves. We don't really care, but we will stay on top. From a service standpoint, it's incumbent upon us to stay connected with the client and whoever's running the asset management account to make sure that it's run correctly, because we want our clients to get the full value out of the strategy. There's nothing worse than coming in and learning a new strategy and then forget about it, and 5 years later it blows up on you because no one was operating it.
And it's so important to kind of stress that flexibility, right? Because that's what this offers, this Leo. And I remember when I first learned about this, I learned about you, and I just did so much due diligence before we even got on the phone, so I could understand it, so I can translate that easier to my clients, right? So what I would tell people who are a little bit on the risk adverse side, and if you realize that you're risk adverse, my man, you got to find a strategic CPA who can kind of translate these things into English for you, right? Because then what seems like a high risk investment may not be.
And Jose, you and Charina both know, and I advocate to clients and to CPAs all the time. Find a CPA. I don't want a CPA who knows it all,
Right. Yeah.
much like I don't want a surgeon who's a great businessman. I want him to know what he does, but then not be afraid to reach out to other people for guidance and advice.
Exactly.
And if your CPA is not bringing resources in via, this YouTube and Google Meets and Zoom video, we have so many resources to bring the live resource to the client. If they're not doing that, they're just being reactive. And you really need to engage with a CPA who sees, because your industry is evolving to being more advisory based. If most people took a tour of Europe or South America or any of the other developed worlds, the CPA or chartered accountant, Australia, New Zealand, they're the fulcrum for every high net worth person's financial life. That's who they call first.
Yes.
They're just the tax preparer.
Right.
And so to see the US CPA industry finally starting to see this and advocate CPAs to be more, it used to be if you talk to a CPA about being more advisory like, it was like, no, we can't do that, ethics and whatever. And then they started realizing, no, it is our responsibility. We do need to have these resources. It's a little harder, but it's a heck of a lot more rewarding.
Exactly. It should be your advisor first resort, right? I mean, they're the ones that should know, like you said, they're not going to know everything, but they know where to find the answers. So I always tell people, when you say CPA, the next 3 words should be ROI, because a CPA should be delivering you ROI in that sense.
Like, it's all about being informed, right? It's not about being aggressive or anything like that. And the tax code rewarding participation, leverage, and risk that's actually tied to economic activity. So if you do understand those rules, you can can use them to turn that ordinary dollars into what I call extraordinary deductions.
You know, Charina, coming from the wealth management side, I would tell you this, and this is where, you know, the CPA industry has been outmarketed by the financial services industry, right? They have tried to present themselves as the financial advisor. And what most clients, even ultra high net worth clients, we met with a high net worth professional athlete that had a team around him of all the biggest banks. None of them could legitimately understand how to plan for income tax. The client's number one expense completely, they're not allowed to have that conversation. So it's understanding, look, wealth managers are basically portfolio planners, right? CPAs are going to be your better comprehensive advisor from a financial standpoint, right? Does it matter if I take $1 million portfolio and get you 10% this year? Wow, you made 100 grand. But how about if you made $5 million and I could show you how to cut your 40% tax in half? Now I've made you $1 million. Right. So it's looking at that facet of, hey, who's doing what? Who can ask the questions? Ask your CPA. How proactive can you be? Are you dealing with advanced tax planners? Do you have strategies that can help me with this?
Yeah, exactly. You know, and that's the great thing about working with Mike. As far as LEOS, any parting shots that you want to give, and not only that, but then tell the people where we can find you.
Yeah, well, you find me through Jose and Charina. First off, I'm happy to have one-on-one conversations with clients. You can reach us at veracityadvisors.com. We have contact information and information about the team and how we scale and operate. Like I said at the beginning, I want to be the dumbest guy in the room. And so I want to work with your CPA team and your advisory team and empower them to do more and more. And you might be the first client we work with them on, and we make a material difference, but then they can use that to help their other clients, really. And that's where we see great value and a lot of fun on a day-to-day basis, really helping see the evolution of the CPA industry, because our clients, honestly, our clients are the ones who deserve it.
Exactly. And I think, Mike, if I remember last year, we had kind of a phone call with one gentleman who had his CPA in the line. And that's really where we could see what we were talking about, right? It's this gentleman, you know, obviously maybe a great CPA, maybe a great compliance type of guy, but he wanted to basically put his risk tolerance on the client. And that is not how we do things. This is something where we educate, we make sure that they have the best education in order to make an informed decision, but no way should your CPA be making those decisions. In no way should you be abdicating that responsibility either.
Well, as a follow-up to my little anecdote about the professional athlete, the first thing that the family of the athlete did was fire the CPA that was on the team, because what we said was to file tax returns. You're making $6 to $8 million a year. You need to have someone who's helping you prepare to mitigate taxes as much as legally possible. The end result, the poor planning of the team and the CPA, is going to cost the young man $1 million in taxes that they could have easily avoided had they had some preventative, proactive strategies. And we're talking W-2 income, not ordinary income and stuff that LEOS could be used for. We're talking W-2 income. So it's really, really, I mean, Jose, I love to work with you and have our weekly calls, but this is the future that high net worth clients need to be aware of and will soon start demanding of their advisory teams, be it their CPA, financial advisor, insurance agents, whatever. They've got to demand this.
That's right. It's all about leveling up here, Mike. You know that. And that's what we do at Veracity. And that's what we do at Scale Collective at Engineered Tax Services. Mike, it's been a pleasure as always, man. Anybody who's listening to this, if it sounds too good to be true, call us. And
let us show you.
That's right.
Thank you so much.
Thank you, Jose.
I wanted to say that I've always enjoyed working and collaborating with Michael. He has helped several of our partners and clients over the years. And Julio and I are very grateful for being able to support you and support others with this amazing relationship that we have.
Appreciate it, Charina. Glad to be a part of the team. Look forward to doing great things this year and into the future.
All right. Thank you, Mike.
Likewise.
All right.
Thanks, everybody.